Okay. Do you have any questions before we start? You got the email about the TradeMaster thing? They're supposed to send you emails. Did you all get emails? Because I found your emails. Okay, everything's perfect. Okay, perfect. So today hopefully I'm gonna finish the mergers chapter, and then on Thursday we're gonna talk about governance. I think I forgot to put the slides on Moodle. I'm sorry about that. And the links I was talking about was the links we have in the lecture notes, but nobody pointed out that there's no lecture notes on Moodle. Thank you for that. Okay, so mergers are important because they are one of the most important corporate events. It's important for corporation restructurings, and it's important for growth, actually. So small companies buy other companies, and they do external growth, basically. And we talk about the basic terminologies about mergers. We know there are mergers, acquisitions, stocks, asset acquisitions, and things like that. But overall, I will call all of them as mergers. And as a reminder, let's start talking about the market reaction about takeovers or mergers. One thing we said was mergers are generally taken as good events by the target shareholders. At the merger announcement, we see an increase in the stock price for target firms around like 15%. And we know that the acquirer has to pay some kind of acquisition premium in order to buy the target firm. Otherwise, target stockholders wouldn't sell their company, their stocks, or the target CEOs wouldn't sell their companies. So the average premium is 43% above the pre-merger price. And we said the market reaction is just 15% compared to 45% merger premium. And we said why this is the case. Actually, you gave me the answer, and you said there are lots of uncertainties about mergers. Just because there is someone interested in your company doesn't mean that the deal will go through. Your stockholders might say no to that, or even if two parties agree on things, maybe the regulatory authorities will say no to the merger. So there are lots of uncertainties about the merger. That's why this 43% acquisition premium doesn't translate into increase in the target stock price. So overall, we can say that mergers are generally good for target firms, but for the acquire part, it's a little bit iffy. We don't know whether mergers are good for companies or not, for acquired companies or not, which is an interesting thing, actually, because they are the ones who are initiating the merger, but their shareholders are not very sure about whether that merger is absolutely necessary or not. From here, we talk about the reasons about mergers, and we said the most commonly used reason that is used by acquirers is synergies. So they always talk about how great this merger is, how there will be lots of synergies, and with synergies they mean the combined value of the target company and the acquirer will be greater than those two separate companies. So it's going to create more value. Those two firms together will create more value. And the synergy value might come from two things. One is the cost reduction. The other one is revenue enhancement. And with the cost reduction case, I talk about AT&T and SBC. So when they merged, there were lots of reduced costs. The simple example is they laid off 13,000 workers, for instance. So together, if they can minimize the cost, then it's going to create synergy, of course. Then we said revenue enhancement synergies are also important. This is probably the best kind, but it is difficult to value synergies. Of course, we will touch base valuation a little bit today. But for this, we talk about Delta and Northwest. These are two airline companies, and they serve different hubs, different routes. So together, when they combine their forces, then they can enhance their revenues because they are covering more routes, basically. So this is another source of synergy. Then we talk about economies of scale and economies of scope. With economies of scale, it's basically as a small firm, you cannot produce things at the optimum point. And being a large company means you can produce in large volume and high quantity. And for this, we talk about StriteRite and Socony. So Socony is a small firm. It has networks in China. StriteRite is a bigger firm. So it's basically win-win. StriteRite is using the networks of Socony in China, and Socony is enjoying economies of scale, basically. And economies of scope is basically companies getting together and using common marketing and distribution methods, like Pepsi producing like cereal. Oh, no, not Pepsi, the company both making soft drinks and cereal is one thing. So they can use same marketing and distribution methods. So this was another reason. Then we talk about vertical integration. Vertical integration means you buy a company, you buy your supplier, for instance. So an oil company buying an oil station, gas station. It's vertical integration. So it might make things more efficient, but it also might make things, you are more dependent on yourself now. So having different suppliers might be a good thing, or you can say, no, I'm going to buy my supplier and things will be more efficient. So it might be a good thing or a bad thing. Not all companies use vertical integration, of course, but it's another reason why mergers can occur. Then we talk about expertise. As a company, you want to go into a new market, for instance, you can go after people and get human capital, or you can buy a company similar to yours. So this is what AXA did with Sanford Bernstein asset management company. AXA is a French-based company. They wanted to go into Wall Street. Instead of finding people in Wall Street, they bought Bernstein, for instance. So it's how you buy how you can use merger. That's another reason to merge. And another thing is you combine your complementary resources. What does it mean? I gave you this example where there's a small company with a very good patent, but it doesn't have enough sources to make this patent realized in the real world. So a big company buys that small company, and big company uses its production facilities for this patent, for instance. So you're combining forces again. So that's another reason for a merger. Monopoly gains part is kind of difficult to do probably in real world, because there are lots of authorities looking at all kinds of mergers, and if there's something questionable, they stop the merger. But what you can do is if two companies in one industry, two big companies in one industry merge, then it's almost like a monopoly for them. So they can decide on the price, how much production they're going to make, and things like that. As I said before, it's easy to say than done. In real world, we don't see this monopoly benefit occurring a lot. Like when we look at rival companies in one industry, when two big companies merge, we don't see any stock price reaction in those rival companies. So it means, I mean, they're kind of the free riders if there's some kind of monopoly in the industry, because the prices will go down because of the monopoly. Prices will go up. So they can enjoy this as well, but in real world we don't see it. But it might be a reason, behind the scenes reasons of a merger. That's another thing. Then there's efficiency gains. In this case, it's very easy to understand. As an acquirer, I say, okay, I'm going to go buy this such and such company. It's a very good company, but the management is really not good. So since I'm a great manager, I'm going to buy that company, use its assets in place, and make this company even more profitable. So this is efficiency gains reason behind a merger. Of course, identifying actually good but looking bad companies is not very easy. But if you can do that, it's a very good reason to do a merger. Tax savings are also important. One might be, yes?
I think we done those, like,
We did, yes. No, I'm just doing a quick review. I wasn't very happy with last week's class, so I'm just going over things very quickly again. Okay, tax savings is another thing. So in two companies separately might be paying lots of taxes, but when they get together, because of one section's profits offsetting the other section's loss, for instance, might decrease your tax payment to the government. So you might enjoy tax savings immediately because of the merger. Of course, if the government is aware of this, if this is the only reason, then you're going to be in trouble. Again, SEC is following US companies very closely. Another thing is by merging another company with not a lot of debt, you can enjoy the unused debt capacity of that company. So it doesn't have lots of debt. You can increase debt by buying that company. And in that case, you're going to enjoy from the tax shield, as we covered in the capital structure chapters. So that's another way of having tax savings. Or since you're buying another company, you are maybe diversifying. When you diversify, your risk reduces. In that case, you can find debt easily. So you can increase your debt capacity. When you increase your debt capacity, again, you're going to have increased tax shields. So that's another good thing about mergers. The last thing is about the tax saving part. When you have lots of cash, you can pay dividends or you can do stock repurchases. We talk about those as well. But when you pay dividends, then investors has to pay tax on the dividends. Or if in the stock repurchase, it's the only reason for the stock repurchase, again, the SEC might say, no, you're trying to reduce your tax payments to the government, so you might be in trouble. Instead, use that extra cash to buy another company. So you're making investment. So this is another way of avoiding tax, basically. Okay, and we talk about two more things, the financial side effects of acquisitions. One was diversification. The other one was earnings growth. Diversification we talk about. So basically, as a company, you're buying other companies, and you, just like a shareholder diversifying its portfolio, you're making investments in more areas, let's say. In that case, this is diversification. And when you diversify, you're reducing risk. So the problem with this, though, is, if the CEO talks about how this diversification will be great for shareholders because they are diversifying, you would say, okay, sir, thank you for doing the diversification, but I can do this myself. I can buy another stock like with one click. So don't overwork for me. I can do diversification. So if they talk about diversification reducing the cost of capital, okay, I would buy it. So now if they say, I'm going to find more money and cheaper money, then it's fine with me. But if they say, oh, we're doing the diversification for you, I wouldn't buy it because it's cheaper for me to do diversification. So it's one thing to be careful about. The last thing is earnings growth. So sometimes companies buy other companies and the merged firm's earnings per share looks really high, which is kind of a good thing, but it might be just an illusion. And for that, we actually went over an example. So basically, here a company with high PE ratio is buying another company with low PE ratio. Why? It's basically a growth, let's say a growth firm buying a value company with not so many growth opportunities. In that case, the merged firm will have high earnings per share after the merger. It's just an illusion, though. It just happened because of the characteristics of those companies. So you would all agree that, like for me, for a growth company, it might not make lots of sense to buy a value company. So to me, growth opportunities might be important. So you have to look at the nature of the acquired firm, the nature of the target firm, and what the real effect is. So don't be fooled by earnings per share delusion. And we went over this example the last time. I think this is where we left, and this is actually the last reason for the merger. And this is kind of related to corporate governance, so I will go quickly over this, and we have more things to do on Thursday. So basically, managers might have their own motives for mergers. And for this, I will give you two examples. One is conflicts of interest. As a CEO, I might be happier governing a bigger company. So for me, the bigger the company I manage, the better it is. It's more prestigious. Probably my salary will be higher. So to me, I don't even care whether I'm making good investments or not. I'm just building empires. Okay, so this might be a problem, of course. There's conflicts of interest here because I personally don't care about the goodness of the merger. Another thing is overconfidence. This is behavioral people's explanation, and it's actually very, very fun. There's a hubris hypothesis. According to this, overconfident CEOs pursue mergers thinking that those mergers will be awesome. So they're confident about their picking the target companies, everything going great. So for that reason, they might want to merge with other companies. What is the main difference between these two explanations? I mean, the result is same, probably making poor mergers. But what is the main difference? Look at the intentions. Okay. In the first one, I'm this greedy CEO. I don't care about my shareholders, and I just want to have a bigger company. In the second one, I'm saying, no, this is a good merger. I'm going to go after it. Everything will be great. Do you see the difference? So my intention is nice, actually, in the second one, even if that's why in the first one I'm saying conflicts of interest. In the other one, I'm saying overconfidence. So it's all about how the manager is seeing the entire scenario, basically. But as I said, I'm going to talk about governance issues and conflicts of interest and things on Thursday. I'm trying to find interesting corporation scandals that will keep you interested in the class. But we're going to go over those kind of problems on Thursday. Okay, so these are the reasons why companies merge. And now let's look at the takeover process. Of course, this is a very long process. Lots of documents have to be prepared. Lots of regulator, it will go step by step, and lots of approvals are necessary. But I will just talk about everything in a very, very simple way. The first issue is the valuation, of course. How are you going to value the target company? And basically, you're going to value them as just like in another project. And for the valuation, actually, you have two cases. They are both related to mergers. So you're going to do valuation. And do you remember what kind of techniques we use in valuation? Discounted cash flow analysis. Huh? Multiples, yes, exactly. Comparables, multiples. Adjusted present value approach. There was more. Flow to equity approach. And yeah, we talk about lots of valuation techniques. So using those techniques, acquirer firms try to value the target firm. Okay? And on top of it, of course, the problem is valuing the synergy part, because if they don't believe that there is additional value added, then it wouldn't be a good deal for the acquirer. So basically, if the bidder's payment or offered payment to the target is higher than the value of the target plus the possible synergies, then it would be a positive NPV project for the acquirer. But of course, in almost all cases, all the NPV goes to the target firm, actually. Target firm is benefiting from all the possible outcome of the merger, just like we see in the market reaction. For the acquirers, if they don't lose money, it's a good investment. So that's how things will look. So we're going to do you're going to use one of those valuation techniques to value the firms. You're going to decide on the offer. So this offer process is also very complicated. It can be an all cash acquisition. It can be all stock acquisition. So in the all stock acquisition, acquired firms gives an exchange ratio. So for instance, I say for one share you have in the target firm, I'm giving you half of my share, or half of the merged company's share, let's say. In that case, valuation is even more difficult because in the cash one, I know how much money I'm gonna pay. In the stock acquisition, I need to have an idea about what the stock price will be after the merger. So it makes things more complicated. Okay, so when do you think a company, acquired company, would offer cash, and in what cases they would offer stock, for instance?
They offer all. They are all
Let's hear Ahmet.
If the stock price of the company is underpriced, they offer cash.
Okay.
And if the price is overvalued, they offer stock because they think that the stock of the company will be.
Are you talking about the acquired or the target?
For the acquired company.
Acquired company. Okay. He has a point. If I'm the acquirer, if I know that my stock is overvalued, then I will just offer you stock. Then you would accept, let's say, less stock for the deal. If we think about the true value. So that's exactly right. Another thing is when you look at from the tax perspective, which one is better for the target shareholders, cash or stock? Stock. Why? If I give you cash, you have to pay tax on it. But if I offer you stock, as long as you keep the stock, you don't have to pay taxes. So there's the investor side and there's the acquirer side. But actually, when you look at the real deals, it might most of the cases there's a mix of payments. So there's some cash plus some stock payments. Okay, I think we're gonna look at a link later today. So we're gonna read the details of an offer later. Okay. So you might have cash acquisition or stock acquisition or a mix of it. And determining the exchange ratio, how much stock you're going to offer to the target shareholders, is kind of difficult, of course. So basically, I'm going to give you a simple example, but then I will show you it kind of matches with real world. So suppose that we have an acquired company and we have a target company. And after the merger, there will be some synergies created. So A is the pre-merger value of the acquirer, T is the pre-merger value of the target firm, and acquirer has NA number of shares outstanding. S is the synergy that will be created from the merger, and X, the acquirer is going to issue X new shares to buy the target company. And if this value, so this is the value of the merged company, acquirer value, target value, synergies, over the new numbers of shares outstanding. So this is going to be basically the post-merger price of the company, right? The total value of the combined firm over how many shares outstanding we have. If this value is higher than the pre-merger price for the acquirer, it's going to be a good deal for the acquirer. So this is the value of the acquirer. This is numbers of shares the acquirer has before the merger, right? So if post-merger price is higher than the pre-merger price, it's a good thing for the acquirer because the market is reacting favorably. So if X is the maximum number of new shares that the new acquirer will issue, then playing with the numbers a little bit, we can obtain something like this. And we can obtain the exchange ratio. So how many shares will be issued by the acquired firm compared to how many shares of the target firm the acquired firm will buy. So this exchange ratio should be less than this part. So what it means is, again, the exchange ratio should keep the transaction profitable for the acquirer firm. So let's write down this formula and let's use this in an example. Okay, so X over NT, so the exchange ratio should be lower than target value plus the synergy that's created over the acquirer firm's value times numbers of shares the acquirer firm has, numbers of shares the target firm has. So let's look at this. If you play with the formula a little bit, you can write these in terms of prices of the target firm and the acquirer firm. So for the price, what are you going to do? We already know that. This is the value of the target firm. If you divide it by the numbers of shares outstanding, it's going to give you the price of the target firm. If you do the same thing for the acquirer firm, it's going to give you the price of the acquirer firm. So it's basically for a market value of equity. So you already know that. If it is the case, you can write this, the same equation like this. Okay. So now let's look at this example. I actually want you to work on it. It's very easy, just plug numbers in the formula. At the time Sprint announced plans to acquire Nextile in December 2004, Sprint stock was trading for $20 per share. So Sprint is the acquirer, Nextile is the target. Sprint stock was trading for $25 per share and Nextile stock was trading for $30 per share. If the projected synergies were 12 billion, which is the S, and Nextile had 1.033 billion shares outstanding, so this is NT, basically, numbers of shares outstanding for the target firm. What is the maximum exchange ratio Sprint could offer in a stock swap and still generate a positive NPV? What is the maximum cash offer Sprint could make? So let me give you a few minutes so you can work on it. Again, first true answer will get you a bonus. You can work in groups of 2, let's say. Okay, let's do this together and you tell me whether it was right. Maybe this is wrong. Okay. Okay. So PT is the price of the target, which is price of Nextile. It is 30. PA is price of the acquirer, price of Sprint, which is 25. Synergies are given. It's 12 billion. And for the target value, if it's not given, but you can calculate it, it's basically $30 per share times 1.033 billion. So this is like something like 31. 30.9 something. So from here, the answer should be 1.665.
Hocam biz 71 bulduk aynısını. %70 yok. Aynısını.
I'm gonna check. Maybe is it because rounding? I don't know.
Bire yuvarlamadık. Bire yuvarlamadık.
Yuvarlamayınca mı şey çıkıyor?
Net rakam oldu.
I'm gonna check with the net number. net number. Okay, this part was the easy part. Okay. The second part, it says, what is the maximum cash offer Sprint could make? What is the maximum cash offer Sprint could make? So how should we think about finding this number? Okay, so we know that in order to buy that company, we have to pay more than $30. Okay? So what is the maximum you're going to offer so that this is still positive NPV? How do you how should we think about getting this number? So there is the Nextile price. On top of it, you're creating some synergies, right? So if you pay the price on top of the synergy to Nextel, so this is the maximum cash you can pay to Nextel, right? If you pay more than the synergy that you're going to create plus the stock value, then it's going to be a negative NPV project for you. So what you can do is this. We know that $12 billion synergy is created, and Nextel has 1.033 billion shares. So per share, it is $11.62. So the maximum you can offer is the Nextel price plus how much synergy is generated per Nextel share. So together, it's going to be 41.62. You can also calculate this number using the exchange ratio. If you multiply this exchange ratio with the Sprint price, because it's the exchange ratio, okay, 25 times 1,666,665, it should give you 41.62 as well. So 1,665 times 25 Sprint price will be equal to 41.62. So this is basically the maximum exchange rate ratio, basically, and also it is the maximum cash that you can pay to Nextel and still make it a positive NPV project. Okay, so this says, let's read this actually, so, part of it, so you will have an idea how mergers are announced. This one is easy, so yes, I can do this. Okay, better? Okay, so it says Sprint and Nextel announced plans for a 36 billion merger Wednesday, creating a new major wireless phone power with a customer base to challenge its two larger rivals. Okay, and it says, okay, common share will be converted into 1.28 shares in the new company, as well as 50 cents cash. So as you can see, like now we just calculated the value if it was just all stock acquisition, but in real world they use 1.28 as the exchange ratio, and they paid 50 cents cash for each Nextel stock. So it says using those exchange ratios, the deal represents no premium for Sprint shareholders who will retain the shares they hold, and about a 9% premium for Nextel shareholders based on Tuesday's closing prices. It's a great deal for Sprint. Again, for the acquired company, it has to convince its shareholders that they're making a great investment. They didn't pay much of a premium for Nextel. I'm not sure how they pulled off, said Greg Gorbatenko, telecom analyst. So it's all about how good you can make the merger look, and whether you're paying less premium for the company you're buying. Because less premium means you're going to create more NPV for yourself. So, okay, this is an example of how we do things in the class, which is really very similar to the basis of what companies do in real world. Okay, and actually with the real numbers, you can calculate whether they offered more than they were supposed to or not. So just there's a link here, and just after the class, I'm going to put the lecture notes, so you can compare whether you can have an idea whether it was a good investment for Sprint or not. Okay, so this is how we talk about the offer of a merger, and now I'm going to introduce you something related, like side information, which is merger arbitrage. So mergers are great opportunities for some shareholders. Because of the risk involved in a merger, you can make tons of money actually. It's very risky, but it might bring you lots of money. So basically what you do is you're speculating on the outcome of the deal, and based on that, you're making some investments. So let's look at this example. In September 2001, HP announced that it would purchase Compaq by swapping 0.6325 share of HP stock for each share of Compaq stock. Okay, after the announcement, HP traded for 18.87 per share, while the price of Compact was 11.08 per share. Thus, Compact's share price after the announcement was 0.8 cents below the implied value of HP offer. What does it mean? HP was traded for 18.87. The exchange ratio was 0.6325. So the value of the offer is 11.93. But actually, Sprint's price at that time is 11.08. So there's a little bit of premium, which should be there anyway. Okay, so as a merger arbitrager, risk arbitrager, if you purchase 10,000 Compact shares and short sold 63.25 HP shares, how much profit you would create? So you're buying 63.25 HP shares at 18.87, and you're basically short selling 10,000 Compact shares. And for those, you're paying 11.08. So the difference between these two will create you around $8,000, $9,000 profit. Okay, if there was a dividend payment, then what was going to happen? Your profits were going to be reduced. Why? Because here HP is paying 0.24 dividend, Compact is paying 0.075 at that time as a dividend payment. So from Compact shares, you have 10,000 dividend payments, and from HP you have 63.25. You're not getting those dividend payments. So the difference is 768. So it's not a big deal, but still you're making $8,000 profit on your assumption of how the deal is going to go through. Okay, so this is basically if the takeover is completed, this is how much your profit you're going to make. You can take that. But if you look at the merger arbitrage spread, the timing is really important, and exactly when you should do this is important. So what happens is this merger was announced that time, and then for the merger arbitrager, actually if you wait a little bit, at this point your profit was going to be even higher. In the next slide, I'm going to show how much higher and how we calculate this. But the merger arbitrage spread is reducing as you get close to the end of the deal. So when the uncertainty is the highest, you can make tons of money as a merger arbitrager. Now let's look at here. So normally I calculated a $9,000 profit, but on the day of the Hewlett opposition announcement, because HP family said, we are not sure about the deal, we don't want it, they have the cold feet. And on that day, HP stock price increased to 1981 and Compact price fell to 850. So at the merger announcement, the prices we have was this. Whenever there's more uncertainty related to merger, then of course the acquired companies' stock increased and the target companies' stock decreased. In that case, if you use the same investment portfolio, then actually your profit was going to be $40,000. So opening this portfolio at the day of the announcement was actually going to lose you around $30,000 at the opposition HP opposition day. So if you knew what was the better day to do to open the portfolio, to open the investment, it was going to be on the day of the HP opposition, basically. But there's lots of risk related to mergers. There are lots of points where the deal might not come through. In that case, you're losing profits, basically. So as a merger arbitrager, you can make money on uncertainty, kind of like options. Other thing is tax and accounting issues. So we talk about valuation and offers, and we kind of talk about merger arbitrage. But there are lots of taxing issues related to that, accounting issues related to that. So what generally happens is the acquired company pays more than the value of the target company, and it's entered as the goodwill in the balance sheet. When there's a cash acquisition, the taxing is easier because how much cash is paid, how much money is paid is easily found. And if stock payment is made, then there will be a capital gains tax when the stock is sold by the investors. So there are lots of tax and accounting issues related to mergers. Since it's not an accounting class, I'm not going to go into the details. Suppose the tax and accounting issues are also solved, figured out, then of course we need board and shareholders approval. So both target firm and acquire firms boards should be okay with the merger. Of course, if it's a friendly takeover, then a shareholder vote is necessary. So target companies, shareholders will vote on the issue, whether they want to be acquired or not. If it's a hostile takeover, then generally a tender offer takes place and acquire firm directly approaches to the target shareholders. In that case, no voting is necessary. If as the target shareholder you want to sell your share, you can do it. And why are they doing this? Because they need your votes in the hostile takeover. If they have more votes, then they can take over the company, of course. And specific terminology in the hostile takeover, the acquirer is called corporate raider, which is self-explanatory, I guess. But takeovers can be friendly or hostile. After that, there are lots of regulatory approvals. So Department of Justice has to approve it. SEC has to go look into the details of the merger and everything. If it has related to anything about Europe market, even if the companies are not European companies, European Commission has to approve the process as well. So after all those things, the merger is finalized, if it's okay in each step. So if a merger is a good thing for target companies, the question we ask is why it's rejected sometimes. And there are a couple of explanations I put here. One, maybe the target shareholders find the offer price too low, which is a very nice way of saying increase the price, then we might be interested. Or if the acquired company offers stocks, the target shareholders might say, hey, maybe your stock is overvalued, that's why you're trying to get rid of your stock, so they might reject the deal. Or sometimes managers' self-interest say no to the merger because they don't want to lose their jobs, the target firm CEOs, so they might not be happy with the merger. I'm going to stop here, and in the second hour, I'm going to start talking about takeover defenses. And we're going to talk about divestitures, LBOs, recapitalizations, and things like that. Let's take a 10-minute break.